Your take on the Fed. Is it done or close to done raising rates? And has the bond market already priced everything in?
I think the bond market's priced most things in, but the Fed, yeah, they continue to go here for a little bit. I think you can debate whether they go 75 more or 50 more, depend on the data, but then it's a long pause.
You know, Reese, we just talked about Goldman Sachs and many others looking to cut their costs. Is cutting, and I hate to say this because you don't want any humans to be affected, is cutting costs the new growing earnings?
I think it's going to be an important factor in 2023. I think revenues are definitely not going to grow like they did this year and the year before. So I think those companies that can control their own destiny by cutting costs are going to outperform.
You know, Reese, I'll come back to you because we look for opportunities, and I just laid out how a lot of best ideas did terribly this year, along with the overall market, except for oil and gas. Everyone hated oil and gas a year ago. We're going to, quote, phase out fossil fuels. All they've done is print money. I think OPEC's probably going to defend the $75 price point. They've kind of made that clear. Are oil and gas stocks still a good investment going into next year?
Yeah, I know it's tempting to want to rotate out given how well oil and gas did relative, but as you're really an expert, Brian, in this area, and I do think you have the combination of China coming back, and I do think obviously everybody got sick in Beijing the last couple of days, but over the next month or two, everyone will get COVID, and then I think there will be a reopening, and you'll be partying like it's 1999 in Beijing and Shanghai by February, March. So I do think the oil demand story in China is going to improve. And it will help the fact that the U.S. is probably in a mild recession and Europe's in something worse than a mild recession. So I think that's point A. Point B, you have OPEC, as you point out, will defend this price. And then lastly, you have Biden refilling the SPR under 70. So I think you do have basically a put on oil. And as long as the price of oil is here to going up, I think these oil stocks work.
Yeah, big balance there. Europe, they're in big trouble. China coming out. We'll see how that weighs on it. Brian, back to you. Yesterday or 2 days ago, gosh, at this hour, my brain has stopped working. I talked about expectations for next year for the equity market. They were low. I think most people would either say we're going to get a recession or a major slowdown. If that's the case, what do we do? Does our audience that's watching right now just buy a bunch of 2-year Treasury bonds and let it ride for the next 2 years?
I mean, it's not the worst idea. I think you've got to be opportunistic, though. So back in October, when the 10-year was 4.25, we were adding duration pretty aggressively. At these levels, that's a little bit more difficult, but maybe you'll have another chance. I think also, as you go into next year, those periods of stress where, high yield spreads widen out, those are periods to add. I think you just want to look for opportunities to add and lock in yield for longer periods of time, because I think a year and a half from now, those Fed funds are going to be a lot lower. The Fed's going to be cutting rates, and you're going to be wanting those yields locked in rather than simply those short-term rates that will be rolling off in a year and a half, 2 years from now.
All right, I've got about 30 seconds, Reese. Kind of give us your elevator pitch for 2023. I should invest in the markets because why?
Well, here's what I think. Basically, for the last 15 years, people have gotten out of the public markets and put the new money into private markets, both equity and debt. And I think 23 could be the turnaround year for that. Only because in 22, we've had a big correction in the public markets, both on the debt and the equity side. And I think that you have not had the same correction in private market valuations. I think the Blackstone REIT is a perfect example. It's reportedly up 10% this year. A good mixture of apartment and industrial REITs publicly traded are probably down 25%. Are their underlying assets any different? Not very much, probably. So my point is, I think that you have that opportunity to improve in the public markets, at least relative, and I think that will help.